Joining us now, John Kinsley, Chief Operating Officer at Prudential Portfolio Managers. And John, you'll be relieved to know that we're moving on to a much softer debate around asset allocation, having had a relatively heated debate in the studio just a moment ago with Leon Lowe from the Free Market Foundation, Ashraf Mohammed from Sycamore Fund. Let's start with your views on the world. And when it comes to asset allocation, are you in favor of diversifying across a wide number of assets out there?
Good evening, Bronwyn. Yes, we are. I think the important point that we want to make is that at a time like this, when there's a lot of uncertainty around the world, and indeed sort of uncertainty in the mining industry in South Africa, listening to your previous discussion, one of the risks that so many investors run is that they allow short-term concerns and fears to completely swamp their longer-term investment decision making. And so we're not talking about your short-term money in the bank that you've got there as a reserve. We're talking about the money that is invested for retirement, etc. And our concern there is don't allow short-term fears to completely swamp that.
John, just to go on to your asset allocation, how are you feeling about the equities fixed income discussion right now? A lot of the chief investment officers around the globe are saying switch out of fixed income products and into equities. Where are you guys sitting on that scenario?
Ashraf, we would agree in terms of the way we do our valuations. So essentially what we argue is that an asset class has a long-term fair value, and one can go into a huge amount of detail about that, but that's not appropriate this evening. But an asset class has a long-term fair value. That's step one. Step two is to ask the question, is it currently trading well above or below that long-term fair value, or is indeed sitting at fair value? If it is well above, in other words, it's expensive, well, then we would argue that the opportunity for long-term returns are fairly remote, simply because you're getting it at a high price. The reverse, of course, is true, that if it's well below fair value and you're happy as to why the reasons are that it's trading so well below fair value, then your opportunity to get a good return over the medium to longer term is so much greater. Now, just to go back to your question, we would argue at the moment, if I look purely at South Africa, longer term, equities are most probably going to offer a 13 to 14% return over the next 5 years, and I can't tell you whether that's going to be front-end loaded or back-end loaded, purely if they return to their equilibrium level. If one looks internationally, certainly we would argue that international equities are even more attractive, particularly Europe. Now, yes, we know that's where the risk is, but that is where we believe the most attractive returns potentially are over the next 5 years.
What level of cash exposure would you advocate is reasonable at this time, specifically with all that uncertainty out there?
In a normal balanced fund, we might still be holding at the moment 10 to 15% in cash if there are regular inflows. But to hold more than that doesn't make sense to us, because you're getting a return on South African cash of 5.5%, and you've got a prospective return over the next 3-5 years of, say, 13% total on equity. It doesn't make sense to forego too much of that return by sitting with too much of your fund in cash. It might be different, Bronwyn, if you've got a low-risk fund, an inflation targeting type of fund, where your client is not expecting that much of a high return. Well, then it makes sense to dial down your risk exposure and not hold as much in equity. You certainly want some equity, and you might build your cash. But it's that trade-off that you have to get right, understanding the client's investment requirements.
John, given the outlook for inflation in South Africa over the next 12 months, and the fact that you guys tend to favor inflation-linked bonds, are you still pushing that idea through in terms of your asset allocation, or have you trimmed that back?
Ashraf, in our inflation plus type mandates, we still hold 20 to 25% in inflation-linked bonds. I must say currently, at current yields, they're looking a bit more expensive than certainly ordinary bonds or corporate bonds. So new money is most probably not going to be finding its way to inflation linkers, but we're not going to sell them. In a normal balanced fund, a Regulation 28 pension fund type of product, there we would most probably hold little inflation-linked bond at the exposure at the current levels.
We also need to get your thoughts on listed property at this stage. There is some caution being thrown into the environment around the performance going forward that we can expect from the listed property arena.
Bronwyn, we've sort of stuck our neck out for the last couple of years in listed property, in that people have been saying it's got to come off. It can't continue giving these sort of returns. Now, we do not foresee necessarily the stellar returns that we saw a couple of years ago, but certainly at an 8% distribution, forward distribution yield, we still believe that there is place for property in a portfolio, and we would still favour property over cash in a diverse portfolio.
Okay, just two questions. Firstly, on your property, how much would you now be allocating it? Is it in excess of 15%? And then my second question to you is, the 13 to 15% you're expecting from South African equities, is that over a 3-year period? So you're effectively saying 5-year period. So you're saying 3% per annum on South African equities?
No. We are saying 13 to 15% per annum over the 5 years.
Okay, perfect. And your allocation for
that's
property?
An annualized return.
Your allocation for property?
Our allocation for property in a ordinary balanced fund, about 5%. In a fund such as a low equity inflation plus fund, between 10 and 15.
John, any consideration for gold in a diversified portfolio? There are those who hold it as a currency. Are you one of those players?
We're not one of those players at the moment. Obviously, we hold exposure to gold via our mining house exposure, but we're not holding direct gold at the moment. It is an insurance policy, and we see a role for it, but we ourselves are not holding direct gold.
John, in your offshore portfolios, what is your exposure to Europe at this point in time?
Our exposure to Europe is most probably about 5% above the benchmark, so over MSCI. So it is one of the higher areas for us. I must say that within Europe, we tend to be focused particularly in countries such as Germany and the core European nations, rather than we've tried to scale away from any of the peripheral areas, noting that you're not going to get away from them altogether, simply because of the infusion of risk.